In this video, I'm going to show you how you can generate income from stocks that you already own. Hi, I'm Camille Gaines here, and on my website, retiresurgeon.com, I write about my investing adventure over the past 40 years or so and my income stream adventure over the past 15 years along with my husband after we accidentally stumbled into an early retirement. In this video, I want to share with you one of the best ways to generate income from stocks. I'll see you at my computer because I'm going to step you right through how to do this in my brokerage account. Now here we are over at my computer screen, and this is my Street Smart Edge platform. So thank you to Schwab for the use of this platform to show you on this video this chart and how you can sell call options against stocks that you already own. This is one of 33 income streams in my Ultimate Rise Wealth Plan that is available on my website right now. And they're slightly alternative income streams. Some of them are more alternative than others. And this particular income stream, covered calls, is a popular income stream with stock market investors. I want to show you exactly how someone can sell covered calls on Apple shares. Let's say in this example, someone has worked for Apple a really long time, and over the years, they've purchased Apple shares. This won't be an example where they've gotten them as part of their plan with the company at no cost or at a very low cost. Let's just say in this example, keep it really simple, they've bought 1,000 Apple shares over the years at an average cost of about $60. Now you can see here, here's a long-term chart of Apple. This is, if you're not familiar, I'll just show you really quickly. This is 2001 back here, and you can see how low Apple shares were. They were about 80 cents back in 2001, and you can see here today's dollars, this is about 133 up here, how the price has risen over the years. This is a great illustration, a visual illustration of how the shares have risen over the years. Over here is the price, and down here at the bottom is the time, if you're not familiar with stock charts. What we want to do, this is a weekly chart, and we really want to focus in on what's happening right now with Apple and why and how someone might sell covered calls. So we're going to go to a daily chart, and let me zoom in a little closer. We can see that Apple closed, it was around $133. The market closed just a little while ago. So in our example, let's look at, I'm going to open a trading window, and we can see that if someone sold a call option in mid-April, which is about 2 months out, I'm recording this mid-February, and here's the drop down with all the different dates. But we're going to look at this monthly option here in mid-April, that it would expire on April 16th. And let's say someone sold a call option with a $145 strike price, and in that case, they would get, in the example that I gave, it's about $2.75 for each contract. Now, here's the bid, here's the ask. So $2.75 is about in the middle, and that would have been a doable trade for today. So in this case, if the price of Apple rose to $145 by April 16th, that option would get exercised by the person we sold it to. Remember, we're selling a call option here. That's how we get the income. We sell the call option, and then that income goes right into our account no matter what the price of Apple does. So we would do the math on that by saying $2.75 in this case times 10 option contracts. And we use 10 option contracts because an option represents 100 shares of stock. So that means that we would bring in about $2,750 income on this, selling these call options, these 10 call option contracts. You can see why someone might do this. Now, let's look really quickly at the chart and realize that Apple may go to $145 by mid-April. It really depends on what's happening in the news, and also, as much as anything, the overall market. That could happen. And so whether or not the owner of the stock wants to sell the call option, they can make a decision on which strike price to use, and that will affect the likelihood of that call option getting exercised. In other words, if they don't care if it gets exercised, they may choose to sell 135 strike, or for April, you could sell a call option for 133.75, which is just over where the price was today. Any 135, 136. So there are a lot of different options here, no pun intended, for strike prices. If someone really, really didn't want it to get called, then they would probably choose the one that's furthest out of the money. If they didn't care and they chose one that's closer into the money, for example, this $133.75, they would get, in this case, about $6.55, an option contract. So you can see how you could get double or triple this example that I showed you, where they sold an out of the money, pretty far out of the money call option. You could also look at selling a call option in March instead of in April. There's a lot of different variables, and it just depends on your own situation as to whether this would make sense for you, and also, if it did make sense to sell call options, how far out of the money you want to go and what time frame, how far out in time that you would want to go. That's how this works on the option end of it. Let's look at the math and help you see even further why someone might want to do this. In this example, they had 1,000 shares of Apple stock that they had bought. So their cost was about $60,000. But what we really have to say is, looking at our net worth, how much capital do we have tied up in this? Because, as I say in the Ultimate Rise Wealth Plan, it's really about how much capital you have and the very best use of that capital. So in this case, if someone had updated their net worth, they would of course put $133,000, because we would say $133 per share of Apple stock times 1,000 shares. So that means we've got $133,000 capital. That's how much money we really have tied up, even though our cost is $60,000. But if we look at the capital that's tied up in that, then let's do that to see what kind of yield we're getting from selling call options. So that $2.75 that we saw that we could get from the call option right here, we said that 275 times 100, because one option contract represents 100 shares of stock. That equals $2,750. But if we divide that by the capital that we have tied up in those Apple shares, we can see that we had about a 2% return, which, so what, right? Well, but what we can see is that it only took us 2 months to earn that money, because it's mid-February and we're looking at selling a call option for mid-April. Now, knowing that, we could probably do that about 6 times a year, and that's pretty realistic, even though the strike price will always vary because Apple stock is moving up and down. It's very realistic that we could get a similar return 6 times a year. And that's even with a very far out of the money call option, as you saw. Let's look, though, at our cost and see what kind of return we got, because we really only have $60,000 of our own money tied up in that. In that case, we would have gotten about a 4.6% yield on selling that call option in the example we just saw. And again, we could probably do that 6 times a year. That's 27.6% return
a year on those Apple shares. So when we compare that to the dividend yield, we can see why so many people like to sell call options on shares that they already own. One of the things I always like to point out is that you already have the risk from owning the shares anyway. As long as you're okay with the options being exercised and the shares being called away from you, then there's really no more risk involved. In fact, selling covered calls lowers risk just a little bit because it's lowering your cost every time you sell a call option against your shares that you already own. That's how selling call options against shares you already own works, and why so many people choose to do that. Again, this is one of the many income streams in my Ultimate Rise Wealth Plan. It's available on my website.